Hello, and welcome back to the Wallfacer podcast. Today's guest is Ivan Kozlov, the co-founder of Resolv Protocol. Ivan, welcome to the show.
Thanks a lot for having me here. Happy Friday, by the way. Not sure that people will be watching this. We'll be doing this on Friday, but nevertheless.
Well, hopefully they can absorb the feeling of a happy Friday, whatever day of the week they wind up listening.
Yeah, let's try to do that.
Cool. Yeah. So, thanks for joining me this morning. I guess before we hop into Resolv and everything that's kind of going on, we'd love to learn a bit about you as a person and how you wound up here. I was just scrolling through your LinkedIn and some other stuff like that. I noticed you spent time in traditional finance, derivatives. I think you studied nuclear physics in undergrad. Yeah. So curious how all of that has led us to where we are today.
Yeah, thanks a lot. I love talking about myself, so don't get me carried away.
Please.
Yeah,
the floor is all yours.
My background is actually, I graduated as an applied physicist. I should have worked with nuclear reactors, basically. But instead of doing that, I shifted to other weapons of mass destruction in finance, as some of the people out there call derivatives. And basically, majority of my career was in TradFi, started in 2010. I worked as a structurer in one of the largest Russian investment banks. And I've done pretty cool stuff in terms of like innovation and things that haven't been done in the local market. And later I was responsible for setting up from a structuring standpoint a product line of investment products, which basically wasn't existing because of the regulation. It changed around 2018. I spent quite a bit of time working with the central bank on the regulation side of things, setting things up. It was kind of like a startup with a large bank. That was super cool, to be honest. So that's my background. At some point, actually, I'm a latecomer to crypto, I'd say. Well, I should have been there much earlier, given my background and interest and everything related to this. But being honest, I was always thinking like, hey, how any meaningful asset can have such high level of volatility, actually. Like a BTC, for example, it's like, what kind of asset is this? That's unreal. That held me off for a while. But then I discovered Ethereum and programmable money, and the whole concept carried me away because I thought, well, any kind of financial contract, any derivative, loan, whatever you call it, that's it. It's going to change the infrastructure. And they just fully shifted from TradFi into Web3. I advised some projects initially and later decided that it would be super cool to build something on my own, because actually I wanted to build something on my own since 2012, I think. But I was always just sitting in the bank, still doing interesting things, but the startup atmosphere fits me better, that's for sure. And I was super happy to be joined by my co-founders.
Great. Yeah, I mean, I think the story that you have there is something that I hear pretty often, actually, which is Bitcoin definitely only clicks right away for a certain set of people that are maybe kind of predisposed to some of the beliefs. Whereas I think for anyone who is or was a technologist, Ethereum clicks really fast for many people.
Yeah. And I can always say that there are like two types of people, right? Like the Bitcoinists and the crypto anarchists. Actually, we see less of those, I'd say, in the last years. It feels like this a bit. And then there are Ethereum guys, and they are like totally different breeds of people, I'd say.
In many ways, absolutely. I guess working on some of the traditional products, structuring that you'd worked on at the bank, I guess, have you seen that really kind of take hold today within crypto? I mean, obviously, projects you're working on like Resolv are steps in that direction, but I'm curious how you see that evolution so far.
Yeah, that's pretty interesting. First, I am still surprised on the low level of penetration the crypto still has in TradFi. And like, say, 3 years ago when we started, I believe I was like almost the only guy within like 200 people I knew at the time who actually kind of took it that seriously to build something on their own and build professional development at that stage. That was a bit weird for me. Now I definitely see how this evolves. Now, like all of my former colleagues know at least a bit about crypto. That's a good signal. But okay, that's kind of obvious, I think. What is less obvious is that I've seen a lot of people who came from TradFi and tried to replicate cool stuff from TradFi and crypto and failed at that. Not because they're bad people or bad founders, but just because the market is totally different. A good example is options, for example, or interest rate swaps. So anyone from finance comes to crypto and says, hey, there are no interest rate swaps, no swaptions, no CDSs, no options. Wow, how come? Like interest rate swaps are huge. It's one of the most massive instruments in TradFi. And there's no such thing in crypto. People start to try building on that. I've seen, I believe, at least 4 projects in that area. But the point is that basically these types of instruments require a certain level of maturity in the industry. And they require corporate angle to this because many of these swaps, they are basically instruments used to work in a treasury format with bonds and everything else, with the longer term borrowings. We don't have that in crypto because crypto lives in a short time spans. And so this is just one example. Options, similar stuff. Why people would use options when they have perps, which are a great instrument, I'd say. Perps have a definite and great product market fit in crypto, that's for sure. Options often used for the same matter in TradFi, but here it is a much more complicated concept. It requires much more diligence, etc., and you have a much simpler instrument, and that's what works. And this also reflects in how we build stuff. I believe stables are like miles away and ahead the current setups in TradFi in terms of structured products, structured nodes of these investment instruments. I can talk a lot about this, or can talk a bit later in more detail. And it's a super simple instrument, which is the cool thing. It's super simple to understand. It retains value. It can bring you some yield. What's not to like here? The main problem is to make it sustainable. And so we took complex things, then we basically work on them and then put them on a simplistic and super cool rails of stablecoins. And that's basically what we do.
You touch on a few things there. And I think the one of sort of maybe some of your former colleagues looking at crypto, I agree that I think there is this, let me think for a second. I'd say generally speaking, there is a case where people come from a traditional industry highlighting exactly what you said. Hey, crypto's missing this product. We need to bring it. But they don't understand the history and context maybe of why crypto doesn't have this thing in the first place.
Exactly.
Or also for some of these products like swaptions and stuff, I mean, these aren't really retail driven products today in traditional markets, right? They're very kind of
they are actually
products.
driven. They are sometimes driven, but they can be used to set up simpler products for retail. So again, these structured nodes, for example, like if you take one of the most popular structured products out there, the autocallable nodes, like it is a complex product generally. Why it sells, why it's super popular, because it's super simple on the surface. You get high fixed yield in dollars. Super great stuff. But inside, what is there? It is a series of path-dependent options on a basket of equities, which is really tough stuff and which requires very dedicated markets. But you're right. What I'm saying is that on themselves, say swaptions or anything else, then they're not packed into something accessible, simple, understandable. It's not a retail product. And we're not seeing institutional or corporate adoption too much in crypto for now. I'm super confident that it's going to change, but yeah. Apologies for interrupting that part.
No, please. But you're correct. And I guess even saying that, if you think about many of the things that have been popular over the last 1 or 2 years, but more broadly as well, and this is a great segue to Resolv, even something like an Euler or a Morpho Vault, which has a lot happening under the hood, the rebalancing, the different collateral types, accepting, offboarding collaterals, Oracle setup, all of this actually like sort of complex lending infrastructure. And then for the user, it's just, hey, here's one product you put money into and you get 6, 7, 8% per year. Yeah, I guess that in many ways you could think of crypto as just this sort of abstraction on top of all of this more difficult finance.
And it's important. I mean, like a small story, a bit of a side story. We actually started by trying to build a wallet for daily users and daily needs in emerging markets. Because I thought, hey, like there actually are regions in the world with relatively high adoption of crypto because of the issues with the local currencies, inflation, capital controls, low availability of USD, etc. Can we make something for such regions, for example, like Turkey, where people could just maybe pay without like your typical Apple Pay, but in your crypto wallet? And obviously, one of the things that was in our minds super profound, the absolute abstraction of everything related to crypto. They should be like a fintech product. Because in real world, people don't think, hey, I have blue dollars, green dollars, yellow dollars, or some other dollars, which lie in this, in this physical wallet. I mean, not crypto wallet, physical wallet, in this wallet. And here I refer to different chains, right? So you have an array of different dollars on different chains. We should have just dollars. And actually, I'm not against this. If people use Resolv without actually using USR or stablecoin, if we can provide them with the yield, abstracted away from the sources, from how complex it is in building these yields and providing them, that's super cool. You need just one button, which is hopefully green, to deposit and then withdraw with a high return. So the abstraction is super important, that's for sure.
Well, that's kind of the perfect segue. So I'm assuming that our listeners are familiar with Resolv, but for anyone who's not, what is Resolv? And you also sort of alluded to some of this backstory that you actually started doing something different. So I'd love to figure out how you got to this idea as well.
Yeah, sure. Actually, we never pivoted per se, but we kind of built on the initial idea, and it changed a bit. And I really love to see how it kind of evolves, where it moves. So what is Resolv and how it started? First, Resolv was based, how I call it, well, it's a yield scale and stablecoin architecture, actually. It's less of a stablecoin because we can work not only with stablecoin, but basically what we do, we put crypto native yields on stablecoin rails. Yes, we have a stablecoin, which basically does that, but we do a bit more than that. Coming back to the idea. So it all started in March 2023, the peg of USDC. Some people may recall this when basically it went down like around 10%. 8 out of 10 stablecoins on the market depeg. We're like, wow, cool. It's quite a bit of a systemic risk and how intertwined it all is. Hey, where can I have my money in crypto being safe and generating some decent yield, hopefully above the risk-free rates? Again, I'm saying nothing bad about USDC, and there are a lot of reasons for that to happen. But at that time, we're like, hey, it's a personal pain. So we started looking into that. And I'll be honest, we looked at the article of Arthur Hayes back then, Dust and Crust, which he wrote, in which basically spurred Athena, actually at the same time, I'd say. We looked at it and thought, hey, yeah, that's understandable, but there are issues with this setup. I actually even wrote to Arthur on LinkedIn, yeah, because I was totally non-crypto native back at the time. And I thought, how can I reach to the guy? I tried to contact him on LinkedIn, saying, hey, I have some thoughts on how this design, we believe, can be optimized. And again, I don't want to say that Athena is a bad design or whatever, saying we are just different a bit. So what were our concerns? Our concerns mainly was the stability of the setup, right? And just for the listeners, so the article of Arthur Hayes was about the delta neutral backing for stablecoins, where basically you take crypto assets and you hedge them with some financial instruments. In the easiest case, it's perpetual futures. And you generate yield this way. So our concerns were about the stability and scalability of this, because you have to trade with taxes. Also, everyone was thinking like, hey guys, do this on DEXs. You're going to be cool. We love DEXs a lot, but you can scale as much as you can on taxes, at least for now. So you have counterparty risk because you have to trade with taxes. If you add DEXs, you still have that risk. It's just a little bit different. It's smart contract risk than being hacked or whatever. This is one risk which is very prominent. And if you recall, it's 2023. It's not too far from FTX. When FTX crashed, like 80% of delta neutral funds get hit pretty bad, I'd say, in general. We're like, hey, we need to address this. Then the funding rates, which can be pretty volatile, they can go into negative. And when then FTX happened, actually, funding rates went down so hard that you could lose just 0.5% of your notional just on funding rates in a single day. Not cool if you lose 0.5% of a peg in a day just due to this stuff. I thought, how can we optimize this? The idea was simple. It's coming from TradFi. And you can basically segregate the risks into a separate instrument, basically a second tranche, a junior tranche. So Resolv has two tokens, the stablecoin part and the risk protection or RLP tranche, which provides higher returns to compensate for the risks which have been segregated there. So if there is a loss in our strategy, for whatever reason, it can be a tax default, it can be negative funding rate, it can be, you name it. There are some other risks, these are just major ones. And these risks are going to be absorbed by the protection layer. So basically what we created an externalized, decentralized insurance fund of sorts, which is driven by the market. And that is pretty cool because it's scalable. Because major stablecoins, they have insurance funds, obviously. But to imagine you grow 2 times in TVL, that means you should go out and ask people to give you money to put into your insurance fund and pay for that. And it doesn't scale that well. In our case, it grows along with the stablecoin TVL. And it is self-supportive in that regard. And we have different mechanics to keep it well-priced, attractive. And actually, this protection layer found its product market fit, that's for sure. When we see how when the rates start to go up, the markets start to become a little bit more lively, people just jump on it. It becomes massive and huge. But yeah, so that's the general idea. So what we do, we basically create a setup where we can segregate the risks and put yields in a stablecoin format. And we want to take this further. So what it gives us, and we understood that there is our competitive advantage, and no one else is doing this, we can have a broadest range of yield sources, or we can have a rich interesting strategy generating the yields. And given the fact that we are on-chain focused, so we're different in setup from Athena, for example, we have assets on-chain, and we have a lot of opportunities to interact with staking providers, working with, say, lending protocols, etc. We can stack the broadest range of these yields, segregate the risks away, and put it on stablecoin rails. We can actually stablecoinize hedge fund or a credit fund. We can stablecoinize basically everything which can have decent returns with some volatility which can be taken away. But yeah, I think I'd have to deep on that part.
No, that's right. I want to definitely dig into that, but I also just want to give any of the listeners context. I'm just taking a look right now on our site, vaults.fyi, and it looks like the 30-day average APY for RLP is 9.96% compared to
Nothing to write
5.2%.
home about, I'd say,
Yep.
for now.
Yep.
Because the markets lately, especially the last 2 weeks due to the conflict, that's pretty much compressed materially.
Yeah.
And obviously the returns for, especially for the protection layer, for the RLP, they are very dependent on the market conditions. So on average, I'd say it's around 17, 18% for the last, since we launched. I believe we've been in private beta since April last year. But yeah, lately, nothing to be bragging about, I'd say. Just how life is.
Just for context, right? I mean, the staked USR rate is about half of that. So sort of, I guess, logically makes sense. And then the highest here that I'm seeing for the average 7-day APY for RLP is, over 30%. So 31.54 is what I see. So, these are great APYs really in any context.
We've seen, I still have a screenshot when basically we had 120% APY in a single day. That was like on a collateral pool when the funding rates just went insane. But there was a prolonged period, I believe in November last year, when Trump won, when RLP was consistently 60, 70, 80% APYs, which is like a bit ridiculous. That's how it is. And that's when actually we got picked up by some of the KOLs and some of the people in the industry saying, hey, take a look, these guys just kind of show some real weird numbers. Maybe it's worth diving into that. But yeah.
Yeah, without a doubt. So, okay, great. So I think we've got a good sense of this. I would love to actually get it a little bit more into some of the ideas around tranching and then kind of come back to what you mentioned about maybe expanding the different yield sources within the product. So how do you guys think about sort of tranching and different kind of subordination risk within the product today? What are the ratios between the essentially junior and senior tranches? I guess the second question too is, I feel historically tranching hasn't really taken off within crypto.
You actually just started what I wanted to mention first.
Oh, great. Okay, well, I guess what I was going to say is I point to you guys pretty often because I talk to a bunch of new teams these days that are looking to get supported on our site or angel investments or whatever. And there's a lot of people, I think, thinking about tranching. And I think you guys have really been a great success story, in the past year of someone who has been able to do tranching in a way that, I don't know, it feels like a product people want. So I would love
I'm glad to feel this the same. And actually this question, I mean, being honest, like we've raised almost throughout all of this history of our project because like we didn't have any kind of big backers or anything like that. So I had, I think, around maybe 500 calls with investors over the span of that. And a lot of them, first they asked like, hey, when we started, there was no Athena. I mean, there was eHorizon, but nobody knew about it. And we learned about them, I believe, somewhere like 2 months in the production, in our case. Because again, we moved basically around the same time. I recall pitching this idea on June 2023 in Belgrade, East Belgrade. And everyone from the investors saying like, why nobody else is doing this? This is like some crap. Yeah, then Athena started to take off with great success. Everyone was like, whoa, okay. But you're not Athena. And how are you going to compete? That was like the second question when we basically started to see this. And then there was also these questions like, hey, the tranches, what the heck? People tried to do this and never flew. Why you think you're going to be successful? I have a relatively simple explanation for this, I think. Not sure it's correct though. The simple explanation is that like back in the days when I've been in TradFi, our distribution channels, one of the heads of those, basically was selling to retail our products. He said, the product must be juicy. And by juicy, it means not only like great yields, obviously that's cool, but it also should be like simple to pick and take and use. Like you take like a fresh fruit, basically. It's in itself. It's simplicity. And here, I think that what we achieved a bit. It's a simple instrument. You don't have some kind of bolts. You don't have to kind of manage this. You don't have to think about it. You basically buy and hold. It's basically what I do, for example. It just sits in my portfolio and it just accrues value every day. And you basically see the price and you can redeem at that price. So it's simple. It gives you leveraged exposure to one of the most popular now trades out there. You don't have to do anything with it. And it's also integrated across DeFi. If you are a degen, you can go and leverage that stuff. You can go and Basically, everything is out there. So I believe that's the reason for success. And I think, again, as stated, stable coins are a great way. It's just a next level channel for distribution of yields because of the simplicity, because of the interoperability, because of transferability, because of everything. And when you just put a good product in a good form or shape, it picks up. So that's kind of the explanation. But getting back to your question about the tranches. So the beauty of this design is that it is market driven. So we don't have specific ratios of how junior tranche is related to senior one. It's just that we target the market levels of the returns in general. So how it works, just basic on the surface, it's really simple actually. So we have a collateral pool. If it has losses, then all of these losses are being attributed to RLP. Its price declines. Since we have majority of assets on chain, this can be traceable, transparent. Everyone can see like, hey, okay, they've lost some stuff because of funding rates, for example, and that reduces the RLP price. This is simple. On the distribution of returns, though, it is a bit more complex, but also relatively simple. So what we do when we earn something on the collateral pool, we split that in two parts, the base yield and the risk premium. This base yield is attributed then both to USR and RLP. And risk premium goes only to RLP, creating these higher returns. So the only thing which is basically hard-coded in there is the ratio of split between base yield and risk premium. And it's 70 to 30 and can be adjusted. But we never had to adjust that because we based the initial numbers on some simulations which we did back then. We constantly monitor this, but during this more than a year, haven't seen cases when which could have proved that their allocation is wrong. But we can do this, obviously. And then there is a cool feature of self-regulation, basically. So if a lot of people go into RLP and the protection layer increases relative to the general TVL, the yields compress and people get out of it. If there are not too many holders in RLP, the yields increase, just basically because we allocate a specific number of funds into the RLP tranche. And people will get in because they'll see like, oh, hey, take a look. So basically this kind of level of TVL of RLP is kind of a leverage factor. But it doesn't come from us trading leveraged perps or anything. It comes from kind of leverage of TVL of RLP compared to TVL of USR. And it's self-balancing. And that's the beauty of the design, I'd say. But that's also what leads to the fact that, say, in bull markets, we've had more TVL and RLP than in USR. And that's suboptimal, I'd say, for obvious reasons. We don't need that much protection. I mean, USR holders don't need that much protection. Obviously, like, I think the sweet spot is between 10% and 30% in terms of collateralization. And we will be adjusting the parameters a bit to work with that. Maybe we'll be adding something to, for example, to distribute abnormal returns of RLP to USR holders in the cases when the markets are booming. But that's something in the works. So yeah, and another cool feature which we've thought about from the start, but we haven't implemented it yet because it's it's not complex, but it requires dedicated customer development and understanding of user needs. We can fix the rate for the stablecoin, right? We can say 8%. And all of the volatility goes into RLP. That can be done, basically like a built-in interest rate swap. Without anything additional, we just can do this. And that can be totally viable because we see how the fixed rates are becoming more and more profound. If you take prime brokers, if you take some of the lending protocols, TradFi guys, come on, they never understand the fact that it can be like single block rate variability. So that's something that will likely be also profound, but we always take a relatively cautious approach to when we implement some features. So likely we'll see that in the future, but we'll have to think this out a bit more.
Hi, this is Ryan, host of the Wallfacer podcast. I want to tell you about our latest product that we think will change how you interact with DeFi. Managing DeFi positions across protocols is complicated. That's why we built Vaults.fyi, a single, clean interface for accessing top protocols like Aave, Compound, Morpho, Euler, Lido, and many more across major networks. No wrappers, no extra contracts, just direct access to the best yields with real-time analytics. If you've gotten any value from this podcast, please try it out at vaults.fyi. The link's in the podcast description, and my DMs are open on X and Farcaster. I read every piece of feedback. Now, back to the show.
Yeah, I think that feels like another great opportunity for you guys to kind of maybe be kind of early slash a pioneer with. I mean, I think we see a lot of success in fixed rate today, obviously across things like Pendle and sort of yield stripping protocols. Also, Morpho V2 is kind of going in this direction with fixed term lending. So, yes, I think there's a lot of demand for fixed term across the board. And again, I think it's a case where for RLP holders, that volatility is kind of what they're buying in for, right? They want the variability of potentially those very high yields. So
Yeah. So basically, the idea here is that we tried to segment the market. There are users in the market who just want stability and normal level of yield. That's USR. But there are others who say, hey, I have some money to use to get some decent returns. I'm not worried that it can go down a bit. So RLP can go down, and it does from time to time. But I just want abnormal returns on longer term. And that RLP provides. And that's a different type of user, obviously. Like the ones, and basically what we say, hey, there are conservative guys, and these are TradFi guys. These are fintechs that want some savings rates, etc., etc. They can all go to USR because they can feel safe that all these crypto-related risks have been taken away, they've been taken care of. But then there are a lot of degens, in a good sense, a lot of DeFi funds, a lot of traders, a lot of users and power users who are less risk averse, and they're totally fine getting into this risky product. And basically, as we grow the backing, we basically provide the leveraged access to an optimized strategy, generation of normal returns in the form of RLP. So it's kind of like in TradFi, it's a big thing of risk profiling, right? Conservative investors, which can only buy, I don't know, bonds, and like the full-blown gamers, which can trade GameStop with 100x leverage, for example. There is nothing like that in crypto for now. Basically, what we do, we make maybe the first step in actually splitting this and actually creating risk profiles. Cool thing is that in crypto, you can basically trace the history of the user easily. You can score, you can understand what level of sophistication and risk tolerance the user has, just judging by the transactions. And you can offer products in one click based on that, based on the risk tolerance and approach. Again, that's not something we're actually working on right now, but just some of the thoughts.
yeah, very interesting. I'd be curious, especially. So I think it's very clear to me who in crypto is interested in RLP. Lots of people, I think, that want a riskier asset that has a higher return. Makes a ton of sense. I guess in today's crowd within crypto, who are the people that are looking for the safer, lower yielding product? Are you finding success there with people who are using it as collateral? Are you starting to get some of those kind of fintech neobank integrations? What does that actually look like?
So I'd say that USR has a less loud value prop for now, for obvious reasons. It doesn't have like insane yields and it's a stable coin. Hey, there is a bunch of others, right? And it's hard to sell the fact that it's much more stable in our perception than others, just because we have 10, 20, 30 times more protection, right? Like it's super over collateralized. The stability doesn't sell in the short term, right? It sells in the longer term, basically, how you can feel this. And our main goal right now, after we have checked the boxes with the listings and the RFNLs and these parts, is to go and specifically work on the distribution of these conservative things. Because basically the pitch is simple. It doesn't mean that it's easy, but it's relatively simple. You come to a neobank, for example, and say, hey, we can provide abnormal returns. Yes, they are sourced from crypto. Surprise, surprise. But you don't have crypto-related risks here because we put them away. Take a look, and actually we have some analysis on how stable the peg of USR was. And it's basically actually better than for USDT. Again, maybe not something to brag about. It's just being arbitrary and everything else. We had also some minor hiccups when we launched the protocol token because of like the pools and DEXs, etc. But in general, it's really stable. And you can sell that when you have the traction, when you have the numbers, when you have good support, investors, etc. And say, hey, it is decent. Yes, it's not something that you'll say, hey, I'm getting 20% every day out there. No, come on, it's not magic. Like we can show the sources. Have a dedicated KPIs for the fact that the USR yields in the longer term should be above anything for the competition. And we have the ability to do this because of the fact that we can stack broader range of yields, as I stated, right? So even after you take a bit to provide returns to RLP holders, since the general yield generation strategy is a bit more aggressive, which we can have because we have the protection layer, right? It doesn't mean that we can just put anything in there. Definitely, it's a really strict approach in what can be in the backing. That means that basically you can provide abnormal returns. So for example, again, take credit funds. Those guys in crypto, which basically make 20-25% on their liquid assets by providing liquidity to projects, etc., right? that's pretty high. You can have this put into the backend, like ultimately. You can have this tokenized. If you can provide 20-25% on that level in a consistent manner, that means even for USR, the yields obviously will be materially higher than, say, for RWA-backed stables or some other crypto native designs. But yeah, I'm touching upon into how kind of this can be evolving.
Actually, maybe after the podcast recording, I'd love to talk to you about some of the stuff we're doing as well with some of these fintech integrations. So we'll come back to that.
So,
But yes, I guess just so one of the things I was very curious to ask about is sort of this broader go-to-market. I think just for the purpose of this conversation, let's say, Athena's a competitor, has an analogous type of product, something they've been just really has blown me away is the distribution that they've been able to get in these different places. And it's sort of a broad question, and you've touched on it a bit, but how are you thinking about distribution across the board? So whether it's the crypto native types, whether it's the more traditional fintech types, maybe it's even more TradFi, like bank type of products, where do you see the next big wave of potential distribution coming?
Yeah, it's massive question, obviously. And I'd say that the distribution is the key. And this will be the battlefield for crypto, different projects. The main point here is that we shouldn't be fighting within crypto. We should be working on onboarding this conservative capital, which is still outside of crypto. And sometimes it makes me sad when I see how people throw stuff at each other in the industry when we have nothing to basically fight about. We have the whole world to work on. But getting back to your point, so I'd put it in 3 sides: on-chain first, then the fintech/consumer, and then the TradFi side of things, right? On-chain, we have, there is the typical blah blah about how we're going to go into the wallets, how we're going to go to Texas, how we're going to push to use USR as a collateral, how we're going to be there and here and everything else, and all of the integrations and building a chain. That's kind of understandable. I think there is nothing interesting in that part. It's just hard work, but that's okay. Interesting thing that I wanted to highlight is that case, which we currently have with EtherFi and P2P.org, and which we will be actively working on and expanding. So the case is simple. Actually, one of the biggest, if not the biggest, distribution channels in crypto are node operators, validators. They have the massive BD arms. They are connected to everyone. They're connected to Texas. They're connected to wallets. They're connected to fintechs because they've been in this for quite a long time, and they actually provide this consistent and institutional grade service. So the best BD teams are there. And these guys obviously want to capitalize on a new narrative. Well, not new, but really loud narrative of stablecoins, which is emerging. But that's not their thing. They are working with Ether, for example, and other assets. How can they capture the value of this super cool expanding segment? We have an answer. We provide that option. We are benefiting from it. So how it works in simple terms, you come to this validator basically and say, hey, how about we offer your clients good product with decent yield on stablecoins? Likely they'll have some stablecoins among their assets, right? Okay, so what's in this for me? So what we do when the client of the validator comes and provides stablecoins, we use these stablecoins to buy relevant assets like Ether, for example. We basically use restaking and staking protocols with which we partnered, like EtherFi, for example. So we provide these stablecoin TVL to these staking and restaking protocols. And then we have an arrangement that these staking and restaking protocols will use the infrastructure of this specific node operator. So what it means is that the node operator is basically getting revenue from these stablecoin flows. He's totally interested in promoting us because he's basically getting this revenue inflows. He's basically taking the stablecoin assets and has a revenue flow on that. It's basically an ability to tap into the stablecoin part. So for them, it's an upside. Why use, say, USDC or USDT, which will never provide you anything, but actually you can capitalize on the stablecoin flow. So the restaking and staking provider, it's increasing TVL. We basically say, hey, we'll bring the clients of validators money to you. For us, it's first the incentivization from the staking and restaking protocol. So for example, we're getting it for 5 points. It's revenue sharing with validators. That's a setup in place because, well, we are providing them with this revenue flow after all, right? And for us, it's a huge distribution because for these validators, it's part of their business. They want to go to their clients and say, hey, guys, please use Resolv, because this way we'll get these flows coming back to us and bringing us more revenue. So they are keen to promote us. They're keen to put us on basically higher position compared to other stablecoin solutions, and we're fully all aligned. So it's TVL. That's the beauty with stablecoins. They basically bring TVL wherever they land, right? And by doing this, all of the three parties benefit, and we believe that it's a big thing which nobody else can do because, again, other setups, they are not using on-chain assets, for example, right? So that's our unique case, our unique advantage, and the thing that we will be actually working on. And yeah, just to give a small highlight of that, we have been joined by a great professional, comes from P2P Ethereum, head of Ethereum P2P basically, who's basically focused on driving and developing these angles of things on the on-chain side of things. So I'm personally super bullish on that part. The second thing, it's less about distribution, but more on the product thing. But like since we started to talk about things that I'm excited about, the second thing is vaults. Yeah, hey, vaults. What's new here? Yeah, exactly. But I personally am I'm not an active trader. I'm a hodler. So I bought like the majority of my crypto assets back in 2022, which is good timing maybe. But I'm super lazy in terms of like I'm not a DeFi degen, like working constantly on different things. I just don't have time, to be honest. And I'd be super happy to have a one-click solution where you deposit USR and it starts to work through all of the integrations which we have. And that's something that we are basically actively working on right now, and we'll release it pretty soon. So it will basically a solution where you take that USR, you put it on, and then a dedicated asset manager from the big names will be basically running the strategies using all of the integrations which Resolv has. And so you'll have to do nothing, basically. You just have to sit and get the returns on that part. And that's pretty cool. I think that's something that could also work well on the distribution side of things. I'm not sure I want to dive a lot into the fintechs, retail, consumer side of things, and TradFi. Because being honest, we are at the start of this. That's been actually our main goal from the get-go. So how we view this? You can grow really fast in crypto. That's for sure. As you can't grow that fast in TradFi. We couldn't been able to go to almost like 700 mil TVL in a few months in TradFi. That's impossible. Unless we, I don't know, are the heirs of some sheikhs, which we are not. So, but it is possible in crypto, right? And when you do this, and then you establish yourself, you build the traction, you showcase the project, you showcase the product, then you can go and scale. And taking this success, you go and put it while working with fintechs. And that's exactly what we started from in line. So actually, when we started thinking like institutional grade stablecoin architecture, what would be the pitch of the project? How does it sound? What it is? And some iterations it was exactly that. And now it's time for us to basically go and target that. But that's a job for 1, 2, 3, 5, 10 years. Totally fine with that. So for example, I am in UAE. And I will be massively focused on expanding locally with getting the local regulation, licenses, etc., being able to push the products on the local scene. We're super bullish on Asia in general. We'll be expanding on that part. And again, that's basically what we did. As structurers, we took some products which never fit any kind of regulatory or whatever setup. We created SPVs on specific entities. We securitized these products to be able to go and, in a regulated environment, sell that to the most demanding clients. Kind of doing similar things now, but in a little bit different way. And so that's the broad picture.
I think the one thing, and there's like a bajillion things I could reply to from that answer, but the one thing that stands out is obviously you guys are thinking quite a lot about distribution. I need to think a little bit more myself about what you've just kind of outlined with what you're doing with P2P, but I think I've got a decent grasp there. The vault idea is kind of interesting because I guess it's Apostro, which has managed a lot of Resolv vaults on Euler historically.
Yeah.
Different, as using the assets as different collateral types. So I guess, is that something that you're looking to kind of double down on with these new vaults that you're mentioning, or how do you imagine those will look?
Well, yeah, basically we are currently working with a range of dedicated names and curators in a space, getting votes, getting terms, and working out the best solution for that. I mean, in all of our approaches, we've always been trying to stay credibly neutral. And the general idea is that we want to grow along with the industry in general, along with all of the people who shape it. Because crypto is actually a small place. So likely you know that for Morpho, for example, one of the biggest distribution chains for them were the risk curators. Because like, hey, you bring them business, right? And they're keen to go and board the projects, the users, and everything to make it better. And so that's same for us. So we don't want to say, hey guys, you know what? we've built a pretty cool strategy. We're going to run it ourselves. We're never going to share anything with anyone. We'll build the walls so that no one can try to tap into this, and we'll try and hold to the last till we kind of can defend this. Now, we want to build a mode in a way that we will be working with different risk curators, with different operators, with different protocols, with different solutions to basically be able to work broadly and in the broadest way. So, but yeah, I think I'm not answering the specific question here. So yes, there will be a dedicated curator will be managing that world, and we'll be basically working tight in how this can be implemented in the best possible way.
Well, I could have a bunch more questions on distribution, but maybe I will take just one more on the topic of distribution, going back to something you mentioned at the beginning, which is how you're thinking about cross-chain today. So, or cross-chain or multi-chain, sort of generally speaking. I saw recently that you guys adopted the Stargate OFT standard. I saw that I think you've expanded or are expanding to like Hyper EVM. I think you're maybe looking at Berachain, some of these places.
So, well, statement. Our home turf is Ethereum, obviously. The simple reason is that that's the place where basically is the most vibrant and developed DeFi ecosystem. I mean, that's relatively simple. We worked with Layer 0 from the earliest days, actually, and are good friends, I'd say, on a project level and a personal one. And they enable the bridging of the product tokens in different chains. We have been generally, I'd say, cautious with massive expansions because, like, to expand to a chain, you need at least 2, but better 3 basic components. You need secondary markets there so that there is liquidity for your product. So you need to launch pools on some of the DEXs. You need lending protocols because these provide the liquidity flywheels. So they create leverage and they can drive TVL, etc. And third, the best case, if you can have some yield trading in there, so Pendle, Spectre, etc. So like you can't just drop a token. So for example, we are on Arbitrum, like we are bridged there, but we've done nothing there. Likely there are some pools, but we never put effort into this. If you don't put effort, nothing happens. So you should go dedicatedly. Say, hey, we're here. So for example, our first chain where we expanded was Base. It was a great success. At some point in time, we've been the second stablecoin there in terms of TVL, I believe, after USDC. And it actually unlocked a lot of retail users because when you're in Ethereum mainnet and the gas is like $30 per transaction, that's not so cool. Then Hyper EVM is a big area of focus too, because again, we've been large users and how to say it, really fully aligned with the view on things on Hyperliquid team in general, I'd say. Though the guys, they are pretty reserved in how they operate. They're like super credibly neutral, etc. But I feel the vibes in general. And we've been using Hyperliquid in our backing since October last year, I think. So we actually became the first stablecoin to have really hybrid backing with taxes and DEXs. And we're super keen to develop and build more on Hyper EVM from the get-go. Our perps got listed on Shell also at the same time as on Texas, actually. And so from the start, we've been we've had some of the largest positions on HL because like the volumes which we hedge there. So keen to work more with that. We're also present on BSC. Obviously, again, I believe we're seeing some of the resurgence in activity there, and it's cool to be there, I'd say. And we just want to put more effort and activity into being present. But when we talk about multi-chain, basically like our daily discussion, where should we go? Where should we focus? Because again, so our team is 22 people right now. We have a massive focus always on the product side of things. So to the point when basically that guy's like, oh, you've got TG, you've got listings, yeah, whatever, it doesn't matter. Like, for them, it was just something happening apart from what they actually built. And so it takes resources to go to any chain, always. It takes resources, time, dedication, work, everything. So we want to be like focused because when you spread out, nothing happens. You need to go hard on a specific case. So, and also maybe picking a bit and touching a bit on distribution on retail side of things. So there is Soneum, as you know, the chain, which is being basically backed by Sony. And what we are actually working on right now is being present there. And well, this is a joke maybe, but our KPI is to be able to buy GTA 6 on PS using USI. I mean, personally, I think the transactional use case for stablecoins, it's very, very high level of TVL, which is needed. So even DAI haven't reached that, right? I'd say. So USDT and USDC. All others as transactional things used for purchases, buying bananas, as Sam was telling Sequoia guys, I think on one of the pitches of FTX, you can buy a banana on FTX, you encrypt something like that. Whatever. To get there, it's massive work and it's a lot of presence everywhere. But hey, if we have abstraction, it doesn't matter. So in the world of the future, you can have 10,000 stablecoins, but if for the user, the only thing he sees is USD and the return he gets, it doesn't matter what fuels that. You potentially may not even have the stablecoin. It's fine. You just need some rails or infrastructure where you can drive the yields through. So if someone can buy, I don't know, the GTA 6 by using USD, but underneath it will be USR somehow being swapped and going back and forth, I'm totally fine with that.
Yeah, I think that gets to the whole concept of kind of DeFi being behind the hood or under the hood, sort of the DeFi mullet in a lot of these cases, right? Someone might be earning yield from USR without fully grasping how they're getting that, but they're just getting paid and they're happy with that result. I've got a few more. Do you have a few more minutes to go over the hour, or do you have a hard stop?
Yeah, absolutely. I actually
Perfect.
put my next meeting half an hour from that time because maybe we had something to discuss additionally. So.
Perfect. So yeah, the next thought I had, actually just coming back around to cross-chain for 1 second. So outside of Ethereum mainnet, what's your second largest chain today? Is it Base or?
Yeah, it's Base.
Okay. So I'm curious about this as well. Like, how do you think about, when at the time you went to Base, it was probably more of an established chain, lots of liquidity, some good projects there, and it's now your second place compared to, say, maybe Hyper EVM, Barra, which are extremely new, nascent places at the time that you went there, a little bit more of the fast money type. How do you think about sort of breaking in and maybe growing in each of those different L2, new L1 environments?
Yeah, that's a good point that these are different things. So basically, when you come to a fresh chain, and obviously, like chains love stablecoins. We are constantly approached by people saying, "Hey, what about you being present here, etc." And again, let's be a little bit cynical here. But the mechanics when the chains have initial deposits to bootstrap the TVL, that's great for the projects, right? You just can get from the get-go some TVL, which is basically popping up out of nowhere. Everybody likes that for obvious reasons. But at the same time, as I stated, you can just try and pop into any chain where the liquidity is for whatever reason. But ultimately what you want to have use case for your product on that chain. So for example, going into a chain which is absolutely unrelated to what you do and what you build with RLP. So for example, imagine there is an NFT chain or some gaming chain, and I come there with RLP and say, "Hey guys, how about leverage returns on delta neutral strategy, bros?" And they're like, "Well, could you maybe tell us something else?" So that's different. And with Base, for example, for us, it was relatively a no-brainer at the time, not just because of the volumes and numbers. And I think, you can argue that, okay, maybe Solana. Right? Solana is cool and great, and actually we target that too. But basically, in terms of deployment and everything else, obviously EVM is much easier for us. And so that's basically was the low-hanging fruit. And where Base goes and how they approach things, etc. And I have really huge respect for Brian Armstrong personally for Coinbase. It's not saying it because they're also Coinbase Ventures or our investors, just of the approach and everything else and how they do stuff, like in a really personal way. So for us, that was relatively simple. And again, this also works with Hyper EVM. Maybe it's a little bit naive, but we are kind of believers a bit. When we see the direction and the idea, which people have when they do stuff, well, this is aligned. I think that it should work. Again, with Barra, for example, again, there was quite a bit of a controversy at some points in time, etc., etc. But the stuff and the idea is decent and it's viable. And it's something that can work in a big way. So that kind of explains where and how we expand. And for more established chains, we just want to understand that there is interest and there is just client use case for what we bring in there.
Makes a ton of sense. I think that's a type of trade-off that people are often dealing with. Yes, there are the giant arbitrums of the world. Maybe it's tougher to break into, but there is all of this existing liquidity. Cool to hear how you're thinking about that as well. I want to come way back to something we mentioned or talked about way earlier, at the very beginning of the conversation, I had bookmarked, which is new sources of yield and things like that for Resolv generally. Yeah, give me some alpha here. Where are you guys thinking? What other kind of yield sources are you looking to tap into? Would love to dig into that.
Yeah. So let's state the obvious. The yield's going to compress in a delta neutral space. There is quite a bit of capacity to grow there, and we'll have some articles on that. I say that you could grow maybe to 20 bill using this, etc., etc. But still, that's going to happen, and that's totally fine. I mean, the markets are becoming more efficient. If you want to stay ahead of the curve, you need to be able to tap into something new. And as always, crypto is notorious for burning fast and dying quickly in terms of projects, right? So you're fancy today, nobody recalls about you tomorrow. New narratives come, new yield sources come, etc., etc. And for us, this approach, when we have this kind of modular architecture, when we can add new yield sources as they appear, as they become prominent, as they can generate the yield, as they provide consistent returns, will give us the way to stay relevant, basically in almost any environment. And in regards to yield sources, there are like some simple things, like we can and we will be expanding in terms of underlyings in the delta neutral strategy, going into alts, etc. That's kind of understandable. Also, we'll be basically expanding like on the Texas and Dexes layers, because that's also affects the yields actually. Outside of the delta neutral strategy, that's where additional interest lies for obvious reasons. And the fact that we will be doing the general approach, so how it will look, we will have them now, but it's less formalized, different clusters within our collateral pool. For example, there is BTC cluster, there is Ether cluster, there will be other assets clusters, there will be just some cool stuff cluster, let's call it this way, if it's not formalized. When you have these clusters, you can optimize within that cluster on that specific asset. If we can use WEIF, right, from EtherFi, we can go and loop that on AVA, for example. We can get material returns on that part. We can optimize on that part, and we can stay safe because of the protection layer, even if something bad happens on that part. We can generate abnormal returns in the base asset, right, class, in the cluster of BTC, with BTCFi and everything else, with Ether and everything else. When we generate these returns on the asset level, we can go and hedge. So basically, all of the setups and opportunities, which are not only stablecoin related, which can sit in a separate cluster. We can also make yield on stablecoins, and we will have a separate model to stabilize the yields when the markets are not that great. Similar to what Athena does, right? Like it's cool that way they shift it into BUIDL. We'll be working actively with some of the other providers of similar solutions in the space to be able to kind of have the protection level of yields, right, when the markets are not great. That's one part. But then there is the part of the underlying assets which can be optimized within that. And there, the opportunities are broad on how you can basically work with the core asset, optimizing that part, and then adding the layer of hedging and putting that into the stablecoin set. So that's just a glimpse on how this is going to evolve.
So I think in that future, is it fair to say that, okay, Resolv is no longer just this, well, I guess it is still maybe delta neutral, but thinking about it less is this like tokenized basis trade type of thing. And really it is just sort of allocating capital to the best risk-adjusted strategies for earning.
Yeah, exactly. So it's kind of, we utilize what works. Delta neutral strategy works. It's great. It's scalable. That's cool. But what's beyond it? The big picture is, again, to stack the broadest range of crypto native fields, put the risks away, and put that on stablecoin rails. As simple as that. On the surface. Beneath this, it can be pretty complicated. And you can say, hey guys, so you're basically actually running a hedge fund. Well, yeah, kinda, of sorts. But we have the product which hedge funds don't have. And this is the composable, integrated across all the stuff, usable, broadly spanning stablecoin.
It's interesting as it feels like a lot of projects are actually sort of going that direction of just, I guess being more upfront about the fact that, hey, we are hedge fund like.
Maybe we're not a stable coin, maybe, right? And actually, in the most jurisdictions, this product won't be called a stable coin because a stable coin is something backed by RWAs, right? And yes, we are upfront about it, like saying, hey, we can be considered a tokenized hedge fund or a capital protected structured product of sorts, depending on what's been back in there, et cetera, et cetera. And I totally understand that this will be a competitive space. That's for sure. And a lot of funds will go this way. Because again, it gives a lot of power in terms of distribution and everything else. Here, the upper hand, I'd say, is our ability to have a broader range of instruments because of the risk protection. But that's not a catch-all, right? It's not like a silver bullet. It's not like saying, hey, guys, we are the only ones with the tranching mechanics, and that's just going to make us great. Obviously not, though it definitely helps and gives us some edge. But the main idea, and that's, I believe, where actual edge in our team lies, is the fact that we've been structurers and we always looked super broadly on all of the markets, underlines, and opportunities to wrap this into a compliant setup. So again, that's not something that you can sell to investors, for example. You can say, hey guys, we're like best fit for the job because we've been doing that for like 10 plus years, basically, but in a little bit of a different space. But that's the personal feeling of why we are positioned to be great in that industry.
Now, there's certainly some truth to that. So we've talked about a lot today. As we're coming up to kind of a close here, I would love to just get your outlook on if we fast forward 5 years from now, everything has gone according to the master plan and Resolv is exactly where you want it to be, what does that future look like?
Interesting question. Fun fact is that I've never been asked that time frame. 5 years for crypto is a lot. But basically, let's try to draw some numbers. For example, I think that currently the market for this kind of yield bearing and yield assets is around maybe 50 billion, something like that. It's like very, very rough estimation. It's like kind of taking a half of DeFi, roughly, maybe, whatever. I think that it can actually grow at the pace, depends obviously, like with the typical crypto markets, it goes up and down. I think in 5 years, that can be 200 bill, absolutely, maybe more. I wouldn't be surprised if it will become a trillion somehow. I wouldn't be surprised if it will be 70 bill. Things happen. But I'd say my personal idea is that it may be around 200 bill, for example. Can Resolv have, say, 20% of that market if we are doing things right, if we are successful, and if we are basically present in a lot of things? I think yes. It can be aggressive thinking, but I think it's totally achievable. Well, would that bring us? I think like 40 bill TVL sounds insane, but hey, I mean, since you've asked if it goes according to the plan, but that's kind of the plan.
Yeah, I mean, that is aggressive, but there really is no other way to be besides aggressive.
Yeah, exactly.
Well, I had a great time today. Thank you for joining the show. How can people learn more about you, learn more about Resolv? What do you want them to check out? How do you want them to get involved?
People can learn a bit more if they basically maybe follow me on Twitter. I sometimes try to share things. Again, I had less opportunities to do that lately because of all the listings and TGE stuff. Now I hope to be more present in there, and I try to be a little bit entertaining. So maybe it's useful. Same with Resolv. Basically, we drive all of the announcements there. Feel free to check it out. But I'd not ask. I don't know how to say it. Propose to check our Resolv journey. So that's basically on our website. There's a specific link. Maybe we can share it somewhere. It's called Resolv Journey. And that journey basically highlights how we started, what we do, what's the general idea, how we're going to drive the value generation into the protocol token and why it's needed, basically. And everything else related to us. So it's like kind of small story, which has nice pictures in there. I personally love them. Who we are and where we go. And that might be really helpful to put things into context.
We'll be sure to drop all of those links in the show notes. And thanks everyone who listened. Please make sure to share, subscribe, and do all that great stuff. All right. Thanks for the time.
Thanks a lot for the great discussion, Ryan. Have a good one. Thanks.